All right, guys, here are 15 things I wish I knew before I started dividend investing. The very first thing that I wish I understood better when I was younger is to start investing early, like as early as you can. Now, I started getting serious about investing for my future when I was about 26 years old, but if I could go back in time to when I was like 16 years old and had my very first job ever at the cookie tree, I would go back and take all of the money I made from that job and the other jobs I had when I was, in my teens and early 20s and just put it into my portfolio, start building that dividend income sooner than later. The younger you are when you start, the more time that you have to let your dividend snowball compound and grow, which means you'll just be able to reach financial freedom that much quicker and live off your dividend income, which is the dream right there. The second thing that I wish I understood better was the importance of investing on a regular basis. When I first started, I didn't really get it. I was maybe throwing in 25 bucks one month, maybe skip a month from there, invest another 25 bucks the following month. I was all over the place with how much and how often I was investing into my portfolio. And unless you inherit a large amount of money, making regular contributions is the only way to build a successful dividend portfolio. And nowadays, it's so easy. You can set up automatic transfers into your brokerage account. So most of the heavy lifting is done for you, and some brokerages like M1 Finance, which is one of the ones I use, will automatically invest those funds into your portfolio so you can grow that thing really without having to lift a finger. The third thing that I wish I had a better grasp on is diversifying my portfolio. And it's true, you don't want to put all your eggs in one basket, especially at first. But on the other hand, as far as diversifying your portfolio, I also don't think you need 50 stocks in your portfolio right off the bat. This is what I did, and I ended up selling out of a lot of those stocks because I realized I have no idea what this company actually does, or I just didn't know enough to realize they probably weren't the best investments to begin with. I think a happy medium and a great place to start for beginner investors is to just put the majority of your money in an ETF like SCHD, so you get that diversification, and then pick a small handful of individual stocks to build upon from there if you want to. The fourth thing that I wish I knew, and I really stand by this one, especially for beginner investors, is to invest in what you know. When first starting out, you don't know a lot about reading financial statements or how to identify attractively valued companies, so you've got to work with what you got. For example, if you hit the Starbucks drive-thru every morning for coffee and egg bites, then invest in Starbucks. If you drink Coke Zero like it's going out of style, as we do here at my house, then buy some Coca-Cola stock. If your weekends are filled with DIY projects at home, then maybe think about investing in something like Home Depot or Lowe's. Not only are all of these good companies, but because you'd be familiar with them as a customer, it helps you better understand what their competitive advantage might be as an investor. Plus, investing is fun, and I think it makes it more fun to invest in companies you actually use, especially when you're first starting out and you really don't have anything else to go off of. With that said, I think the beauty of dividend investing is that really anyone can do it. I mean, I didn't have a background with this stuff. I didn't go to school to study finance. But in hindsight, considering how much I love investing now, that probably would have been a good thing for me. And on that note, I want to tell you about today's sponsor, Southern New Hampshire University. Now, as someone who actually didn't finish college and most certainly wasn't after a degree in finance when I was going, there are times where I don't feel the most qualified to talk about some of the topics we cover here on this channel. Because of that, I'd be lying if I said I'd never thought about going back and finishing my degree. And if you feel the same, if you feel like your experience is holding you back from pursuing the career that you really want, then I am so excited to tell you about today's sponsor, Southern New Hampshire University. SNHU has one of the largest accredited nonprofit online degree offerings in the country, and I want to talk to you specifically about their finance program. In this program, you'll learn to identify long-term corporate investment opportunities to increase shareholder value. You'll learn to apply theories of asset allocation, security analysis, and portfolio diversification to efficiently manage an investment portfolio. You'll learn to utilize the rules and regulations for financial accounting and reporting in a global economy. You'll learn to generate financial records and financial statements for users in accordance with governing rules and regulations. And you'll learn how to analyze, interpret, and communicate financial and accounting information to internal and external stakeholders. SNHU is radically affordable, with their tuition rates being some of the lowest in the nation. Also, when you go to request information about one of their 200 plus different programs, a real person will hop on a call and discuss how the program can benefit you personally. To learn more, go to snhu.edu/Ryan or find the link in the description to see what the current average annual salary is for someone with a finance degree and to request more free information about the program. It only takes one click to find your calling, so once again, go to snhu.edu/Ryan. This one's a tough one. It's to stay disciplined. Guys, the market is full of ups and downs, and if you plan on being a long-term dividend investor, you will experience all of it. But no matter which direction stock prices are moving in, it's so important to stay disciplined and stick to your plan. Keep contributing to your portfolio, keep buying stocks, keep reinvesting dividends, keep stacking that cash flow. By doing that over a long period of time, your consistency and your discipline will be handsomely rewarded. All right, number 6, this one actually kind of ties into the last one. It's be prepared for volatility. Like I said a moment ago, it's full of ups and downs, which sometimes can be gut-wrenchingly aggressive. However, experiencing these swift and sudden changes in the market just comes with the territory. And like anything else, the more you're exposed to it, the less scary it becomes. You will develop thick skin, trust me. All right, number 7 is to have realistic expectations, especially with dividend investing. This is most definitely not a get-rich-quick way to invest, which in my experience is what most people are looking for, which I don't blame them. Dividend investing is one of those things that starts really slow but gets better over time. And as an example, in my entire first year of dedicated dividend investing, I only made like $110, but now, as I'm going into my 4th year of doing this, got a couple years under my belt, I'm bringing in that much every single month and then some. Now, I'm not going to retire or anything with $150 coming in every single month. The point is, I'm a lot farther along today than I was this time 2-3 years ago. And with that said, if you're going to get into this style of investing, don't expect to retire overnight. This is something you're going to be doing likely for 10, 15, 20, 30 plus years. But if you stay disciplined, like I said, in a small handful of years, you can really come a long way, and it just gets better with time. All right, number 8, reinvest your dividends, guys. Fortunately, this one is pretty common amongst most investors, but I don't think I really understood quite how this worked when I first got started with investing. But reinvesting dividends can make a huge difference. For example, if you invested $10,000 into Coca-Cola 20 years ago in 2003, with dividends reinvested, that $10,000 would be worth about $48,000 today. Now, without reinvesting dividends, that same $10,000 would only be worth about $27,000, so quite a big difference. Number 9 is focus on quality. I know how easy it is to be drawn in by these high dividend yields like what you'd find with something like AGNC or NLY, but these yields aren't sustainable. In fact, in both of their cases, the dividend per share is going down over time, which I think qualifies them as a certified yield trap. Instead, you should focus on companies who are doing the opposite and are growing their dividends over time. There's quite a big list of them out there, guys, with pretty extensive dividend growth histories. I mean, if we look at Procter & Gamble, Lowe's, and Coca-Cola, these all have dividend growth histories over 50 consecutive years. And this brings us to number 10, guys. Don't let emotions guide your investment decisions. Don't do it.
Don't do it.
This is easier said than done, I know, guys, but it is so important to stay objective and approach your investment decisions using your head, not so much your heart. My friend Harris actually has a really good approach to this. He gives himself a 2-week holding period where if something bad happens to one of his companies, he forces himself to take the time to digest the information and research what's going on instead of making a rash, knee-jerk decision. I think that's a pretty good approach. All right, the 11th thing that I wish I understood better when I first got started is understanding how dividends are taxed. While it's not a huge deal when first starting out, taxes become a much bigger issue down the road when your portfolio grows and your dividend income becomes larger, and not all dividends are taxed the same. You've got your qualified dividends from companies like Procter & Gamble and Coca-Cola. You've got ordinary dividends from real estate investment trusts and business development companies. You've got return of capital and distributions from master limited partnerships. There are a handful of different types of dividends, and knowing the tax implications of each one can help you save a lot of money in the long run. All right, the 12th thing that I wish I knew the importance of when I first got started is to stay informed. After you invest in a company, you should do your best to stay up to date and stay informed on what's actually going on with the company. And you don't need to necessarily know every little thing that happens on a day-to-day basis, but you should at least take the time to listen to the quarterly earnings calls and read the annual reports. These are 2 things that I wasn't doing when I first got started with investing, but just doing these 2 things can be huge for your development as an investor, and they can really help you get a better understanding of what's going on with the companies you're invested in. You will make mistakes, and it's okay. If dividend investing is something you're going to be doing for the next 20, 30 years, then in that period of time, you're absolutely going to make mistakes. It's pretty much inevitable. But when you do make a mistake that ends up costing you some money, just think of it as your tuition. You're paying your dues, and in exchange, you're getting a valuable lesson that hopefully you can reflect on and use that to improve your skill set as an investor. Now, while dividend stocks are a great investment, guys, number 14 is also invest in yourself. Some resources out there like YouTube are obviously free, but I think spending money on books is actually a huge hack to becoming a better investor. Some of my favorite investing books are Warren Buffett and the Interpretation of Financial Statements, The Intelligent Investor by Ben Graham. This is an absolute classic, although it kind of reads like a textbook, I'm not gonna lie. Richer, Wiser, Happier by William Green. This is a fantastic book, highly recommend. And last but not least, Buffett, The Making of an American Capitalist by Roger Lowenstein. This was a fantastic biography on the man himself. I highly recommend it. And guys, last but not least, this is probably one of the most, if not the most important one. It's to enjoy the journey. Making the commitment to invest for your future, I think, is one of the best gifts you can give to yourself. And along that way, especially knowing how long it takes to reach financial freedom, it's important to enjoy the process and celebrate all of the small victories that come along the way. Every penny added to your portfolio, every new dividend income milestone that you hit, every time something like this happens, guys, give yourself a little pat on the back because you're doing good. I know it starts slow, and I know how hard sometimes it can be to get excited about investing, but you will reach a point, and it will happen sooner than you think, where your dividend snowball will really start to pick up speed and it will really start to take off. And that's what I'm telling you about in this next video right over here. I'm gonna share with you where this point is, when it happened for me, and what it's gonna take to reach this point in your own investing journey. So click right here to learn all about it, and I'll see you in the next one.